Welcome to Money Masters, and I'm here with another Money Master who has such a rich experience going back nearly 3 decades. Meet Mahesh Patil, Chief Investment Officer of Aditya Birla Sun Life Mutual Fund, and he has been an old hand. He has been, for how long you have been around here at Aditya Birla?
18 years at Aditya Birla Sun Life, yes. But overall experience, okay, since 1993 onwards. Yeah? So
Tell me how it all started. Tell me how it all started.
Sure.
It's almost like asking you for your biodata.
Right. No, actually, see, I started off, I'm an engineer, right? So, in those days, right, either when you want, after year 12, either you wanted to be an engineer or a doctor. That's the only thing which was there in your mind. But, that time, never really thought about markets. Though I think I was, to some extent, exposed to the stock market because my dad, though he was a government servant, but he had some investments in stocks. And some of these classic blue chip names like Castrol, for example, Hindustan Lever. And he used to always, these are some of the shares which he had taken, in the early days. And he used to always tell me how those investments had grown and how he used to get regular dividends. But that's the only knowledge because we came from a very middle class kind of a family. And then after I did my engineering, electrical engineering, worked for 2 years in a computer company. And then
Which computer company?
This was CMC, which was the ex-IBM.
Yeah.
Right?
Which is now part of TCS.
Yes. It was one of the first company which you remember that happened, nationalization happened, right?
The mainframe, yeah.
Yes.
The mainframe maintenance.
So I was actually maintaining the big mainframe computers, right? Okay. So interested, but not really what I wanted to do really. That's what I thought. And then obviously you do an MBA, right? So I did my MBA in finance from JB Amis. And that was an interesting era, if you look at that was 91 to 93.
Okay.
And two big events happened in that period. One was the Indian economy had gone through that big crisis, right? When you had to mortgage your gold, there was a big current account deficit. And that's the time when the big reforms happened. We were taught in college that time about the globalization and liberalization were the two key words, right? And that really was a big transformational phase for our economy and for the financial markets, I would say. And at the same time, I think when we were in the last year of our college in my management, that's the time when the Harshad Mehta bull run started, right? Scam happened, right?
1992.
In a way, actually, that gravitated a lot of people, young people, towards the market because while we were interested in the market and we were learning at that time, right, in college, and we wanted to really experiment that, right? What you learn in college in your financial markets, right? You want to implement that. And we started investing in stocks. And that time it was crazy, I remember. The kind of money you could make in a short span of time. People used to, every day, they used to carry the Bhav copy, go every day and see what the prices were, right? Before they came in the newspaper. And the kind of...
And it used to get printed soon after the market was closing.
Yes. And that really, that was an exciting period. For whatever it lasted, we saw stock prices go up 3-4 times in a matter of 4-5 months, right? And that's the kick. You see what money can do.
Did you experience it in a real sense of investing?
Yeah, sure. We invested. It was small. So we had a small club of friends, right, in college, right?
You pooled the money.
We pooled the money and we used to invest over there. And each one has to come. That time it was more driven by rumors, right? It was all news flow which was there. Somebody is saying, okay, we'll tell you buy this stock, and you bought that stock. You did some kind of a preliminary examination, and the run up in the power. It was one was the sharp increase, but what stock market can do, right, to the returns. That was something which fascinated. And obviously one had, when we were going through the MBA program, being an engineer, you always had the analytical mind, right? And this is a profession which I thought, where you can apply analytics, right, your knowledge, analysis, and that's where I think it's an area which
will be challenged
every day of your life. So I always wanted to get into that. Didn't get an opportunity initially. Right, so I had to join a company which is Tata Economic Consulting Services, but that gave me a good grounding in terms of how to evaluate company. It was a project finance company.
Okay,
and that's where
Tata Economic Consultancy used to produce project report for companies.
Yes. They used to do market research. project report for any
This
new
eventually
investment.
also became part of the TCS.
Yeah. So I'll come to that, how my journey really panned out. So that gave me an insight in terms of how to
No, because
research a
your
company.
career journey,
Yes.
is talking about the genesis of some critical, very important businesses that has evolved in the
Right.
country the way it is.
Right. So I started off in Tata Economic Consulting Service doing project evaluation. So any new project which needs to be evaluated, what is the funding required, whether the project viability report. So that gives you a good understanding in terms of looking at the technical aspects of a business and also the financial viability of that and preparing the business models. So that I think was a good grounding, which one got, and a good interesting to meet and interact with companies when you're evaluating them. And then, and that was very early days for equity research. There were not many research firms which were there. They were just mushrooming up. A few of the MNC firms were just
And
setting
the one
shop.
which actually came up with a bang, which was Growmore.
Yeah,
that
yes,
collapsed with Arshad
yes,
Mehta.
yes,
So
right.
That was the
one.
infamous
That was
one.
the thing. So I joined. I got an opportunity to join Parag Parikh Financial Advisory Services, which is again a boutique kind of investment firm. Parag Bhai, he was known for value investing, right? And that was a good grounding over there because that really taught me how to do research. So we had a fantastic team over there. There was
That was the broking operation.
It was a pure broking operations. So I was tracking a few sectors and doing research on that. And that's a period where I really got ingrained into really hardcore research. And at Parag Parikh also, I think because of Parag Bhai's exposure, he always exposed us to read a lot and also to look at companies beyond the numbers, right? So I remember there used to be a gentleman called Chandrakant Sampath, right? He was a close friend of Parag Bhai. So he used to bring us and he used to tell us about Warren Buffett books we had
He's a
read.
legend.
He's a legend, right?
Yeah.
And how to look at companies, how to look at brands, right? Look at long term and how to invest in companies, which are generating good cash flows, have strong brands, strong moats, and that's how I think the journey started. And then eventually moved to Motilal
You
Oswal.
attribute your foundational basics to him.
To a large extent, right? And at that point in time, if you look, a lot of multinational companies were coming out, and they were really big wealth creators at that point in time because they had a feel. I mean, India was a growing market. They had the technology, they had the resources, and there was not much competition in those days. So some of the MNC companies were really darlings of the market, and I mean,
And also
you have to
they-
just buy and hold those stocks, right?
And the other thing was, they were also not stealing money from the company.
Yeah. So
Because
corporate
Indian
governance,
promoter-
and the biggest problem in that time in the markets was about there were a lot of promoters who came into the market, and the quality of promoters was not always that great. And that's the time when
Indian
the
promoters,
Indian
Indian
promoters.
businesses.
And a lot of foreign investors who came in for the first time, I used to say, some of them used to be just taken for a ride. I mean, they came in over here, they used to meet the company, right? Look and meet the promoters and just go back, right? And they will tell a story, right? So investing in a company with good corporate, right, promoters, if you do that basics, then automatically the opportunity is
Everything
there,
else
everything falls in place. And that was a big learning in that sense. Obviously, it didn't dawn at that point in time, but the mistakes one did over a period of time. So the journey started in equity research, then to Motilal Oswal.
Motilal Oswal.
Yeah, which was again a great place to work for. Ramdev Agarwal, as you know, right? Again, he's been a legend over there. So that was again where the grounding happened. And then in that interim period, after somewhere before the .com bust, I decided to move into. I mean, had enough of equity
Late
research.
90s.
Yeah, late 90s, and the market was also really kind of dull after that. But it didn't really do much over that point in time.
Which year was this?
This was in just before the .com bust in 1999.
1999.
Yes.
Yeah, so only technology, pharma and
Yes,
FMCG was working in
that
the
was,
market.
That was again a different era altogether, right?
Yeah, that's
So that-
troika of
I
these
mean,
three
after
sectors.
the Harshad Mehta bull run, that was another run where it was purely specific to technology.
Three sectors and
Three
okay,
sectors
yeah.
and this thing. So that time telecom sector was evolving. So I was a telecom research analyst, and I thought it would be good to really be on the other side, on the corporate world, to see actually how to understand that business and industry much better. And that's the time I joined Reliance Infocom, right, with Mukesh Ambani and the team. So when they were conceiving the whole telecom project, and that again was idea was to just work there for a couple of years and then probably come back. But that was again an exciting period. We were actually getting into a business which was starting from grassroots, and the vision, with Mukesh Bhai had at that point in time really to ensure that every person has a mobile phone, and to implement that dream again was a great experience. I mean, to work with such a large organization which is good
actually,
execution.
today we are actually forgetting that what the deal was.
Yeah.
The pitch was that the cost of a call should be less than a postcard.
Yes,
And that actually happened.
Actually happened, and I was fortunate enough to be the part of the dream.
A postcard still costs 15 paisa.
Yes. So that was a period, okay, which was exciting. But the fun only is there when you are there. Once it becomes launch and steady state, I mean, that's where the excitement really fizzles out. And then I came back, okay, to the industry. I was fortunate enough to get a break in Aditya Birla Sun Life mutual fund.
Was it Birla Sun Life then, or
it was Birla Sun Life.
Capital International?
No, Birla Capital International was pre-2000.
Okay. It has already happened. Okay.
So that was in 2005. I joined Birla Sun Life Mutual Fund, and I've been since then for the last 18 years over here, and that's been the journey really. I mean, so and when I joined Birla Sun Life Mutual Fund, right, I came in there with no real prior experience of fund management as such. I was a research analyst, been with the corporate world, but I think that's the time, again, fortunately or whatever, it was a period, right, when the markets were doing well, right? So it's a beginner's love.
Beginning to do well.
And
big bull run
which was there. So you have something luck or whatever. Initially, when you start fund, I started as a fund manager and as a research analyst, and started managing a few of the funds. I remember that point in time when, again, Birla also that time had gone through a cycle, right? Okay, after the dot-com bust, okay, on the equity side, okay, we had seen a big downturn and erosion of fund, and that's the time when there's a large acquisition which Aditya Birla done, which was the Alliance Mutual Funds. And when I joined, I mean, all these funds came together, and I had to look at some of these funds, right?
In fact, I remember, we launched our magazine in 2002. And the first interview in that magazine was of Bharat Shah.
Yeah.
And he was the CIO of Birla Sun Life. And he was the first CIO of your company. And the headline of that interview was, "We bought well, we didn't sell well," which was in the context of that technology company, which became a very significant part of the portfolio, and then it actually didn't work out. So yeah, a lot of stories, a lot of history.
Yeah. I mean,
in the context of this,
right, I think each market, right, crash or whatever is a learning phase, right? You learn from that and you grow.
Was it eValue, sir? No, what was that company's name, which was a very significant part of the technology company's position?
I think it was VisualSoft. VisualSoft you're talking about, right? Yeah. So again, that was one era, right?
Yeah.
So when I joined in Birla, again, the whole team had changed. So it was virtually a new team, okay, which was there, and we built that team from there. Okay,
you were a fund manager or you were a research analyst?
I was a fund manager and research analyst. In fact, all the funds came on my lap. Sometimes you don't ask for it, right? People want to be fund. It just came in because there were so many funds which were there. Alliance funds came in. They had a good track record, fortunately. And the good thing was that at that point in time, the capital goods sector was doing very well. If you look at, there was a big boom in capex, right? Because that's a period where you saw a lot of capital goods.
2003 to 2008,
right? And since I was a capital good analyst earlier at Motilal, sometimes you have certain core strengths in a few sectors. You don't know everything, right? When you're doing fund management, you will always focus on your strengths. And fortunately, those sectors did well, and the funds also did well. And that gave me some time to really master some of the other sectors, okay? Like, for example, banking, pharma. And we had a fairly good team at that point in time. So that period until the global financial crisis.
Did you not miss any mentor there? Because, you were coming from related background, but interesting background, but you didn't have a heavyweight keeping an oversight.
Yeah. So I think ideally one would have wanted that, right? Somebody, because when I joined here, the whole team had left. It was virtually a new team which was there. And but I think the experience which I had, right, earlier, right, working with Parag Parekh and this thing, I think that helped me over there. And as I said, sometimes the market itself is more supportive, right? It was a forgiving market, let me tell you. Okay. So it gives time, even if you do some mistakes, it's a forgiving market. And that gives you time to really build.
Yeah, right? that was the phase when just for our listeners, from 2003 to 2007, the market went up from 3,000 points to 20,000 points. So that is how forgiving.
That was one of the longest kind of a stretch. I will tell our investors, there were many instances in that period where the market corrected more than 20%. Right? But
of course, the government changed without a notice, went down by 14%.
So just to tell investors, because people get worried, okay, when there are market, even a bull market like that, right, which is a secular bull market, we had, I think, 3 instances of the market corrected more than 25%. So that's a part and parcel.
2004, the government changed, and one day the market went down by 14% or some such thing.
Yes. Right.
How were you positioned then? Just paint me a picture of the context. How painful it was, or how.
So in 2004, I was not there, but there were other instances, okay, where we saw, okay, the market corrected. See, you can't do much, right? Okay, when you invested, okay, you can't do much about it.
You come to office at 9:30 and you see that the market.
Nothing is you can't do. But I think knowing the markets, we invariably know that, okay, I mean, markets tend to overreact, right, on either side, right? And those are one of the instances, okay, which actually that's the time when actually one gets excited, frankly, because as a fund manager, because that's where you see value in the market, stocks which you wanted to buy and which you missed, right? It's an opportunity to buy that. And the only challenge is that whether you have liquid in your portfolio to do that, because you also have the other stocks, right? And that's a time actually which gives time to really churn your portfolio, right? Get away some of our stocks, okay, which you wanted, and then get into some. So I think market volatility actually is a friend of a fund manager. That's again comes from experience and what I've learned. So that's the journey from Aditya Birla, I think, where then we had the global financial crisis, which was a big learning experience again. Again, that really shook me, right? Because that was the first shock, right? When you're actually managing money. And fortunately, again, one was able to navigate that much better because portfolio was fairly liquid. And that is time when actually we learned, right, at least for me, that it's not what you're looking. Normally, you're very inward focused. What's happening in India, right? We really purely bottom up. But that's when we realized that it's also important to look at the macro, right? Because that it was all about the global macro, right? Which people talked about it, but it manifested, and nobody thought that what's happening in the US will have such a large impact across this thing.
That, if there is a war, the bomb will not drop on my home.
But that's the event which taught us that all the financial markets are interlinked, right? If something sneezes in this thing, it will impact all the financial markets, at least in the shorter term, right? Later on, okay, there could be divergence depending on the fundamentals of each market. And that's where I think focus on global macro, understanding that, right, is something which we also try to build as a part of a process. But more important, that's the first time actually we put in some framework in place.
Okay.
Framework in terms of risk management, right? Okay, what is the, and that's the time I also, from fund manager, I became a head of equity.
You started framing rules and processes.
Because that time there were no really rules. And that was the problem initially, what happened also earlier, concentration risk or whatever, which was there.
So Birla Sun Life was Wild West.
Yes.
In a way.
Not exactly. I think that was not Birla Sun Life, I would say. It was true for
mutual fund industry as such. Internally, everybody was free to do whatever they wanted.
Right. And that point in time, I happened to go to...
No, give me an example of the process that you implemented.
Sure. So when I had gone, I'll just give a background to that. So I had visited MFS, which is Massachusetts Financial Services, which is Sun Life's asset management company. It's the oldest institution. It's more than 120 years, right?
It's among the first few mutual funds.
Funds, right? So you had gone there for a 1 month kind of this thing, and then they look at some of their processes. Okay, how do you look at risk management? What is the kind of risk you take in a portfolio? The active risk. When I say active risk, in the sense, how much you should own a particular stock at a stock level vis-a-vis the benchmark. Because always when you talk about risk for fund managers, you have to beat the benchmark. It's all about in relation to the benchmark, what is the risk you're taking. So what is the risk you take at the stock level? At a sector level, we put some guidelines in place at that point in time. And that probably became a cornerstone for us since 2000.
But did you not have this kind of rule for frontline equity even before that?
So frontline equity was a fund which had a sector level limit, which was there. Okay. So that was one of the funds which I started managing.
I can just recall that.
Yes, that is true.
Because it was benchmarked to BSE 200. It was supposed to have plus minus 10% of the benchmark sector allocation.
Yes, some kind of
that. That is what I can recall. I was also very hands-on analyst then.
Right. So that was very fund specific at that point in time, and I think that was whoever thought at that point in time, I think that was I think no other fund had that kind of guide rails. Being put across.
All fund didn't have.
I think no fund in the industry had that.
Okay.
But as an institutionalized, we introduced that at that point in time. And then we had a very good run, right, from 2013 to 2018. And then every asset company goes through a cycle, right? Okay, I mean, you've seen there are cycles which come in because of certain style which you are managing is not in favor, certain stocks which did well for you. And we had that patch, right, 2018 to 2020, 21, okay, where we saw some kind of a downturn over there. But again, that was a learning, and we'll talk about that later in terms of what were the learnings from that. But that's pretty much been the journey, I think, seen various ups and downs in the markets, various failures also, right? When you're managing in the fund management business, within 2 periods, when we came out from the bottom and then again resurrected.
Tell me about, couple of, few examples. I'll be interested in some anecdotal stuff. That what if you just, came to your company and see people functioning on a day-to-day basis? What is it that has changed dramatically? And what is it that has not changed at all?
So I think what has changed, I would say, is that a lot of processes are put in place, right? So again, it's also because of the regulatory environment has changed quite a bit, right, in that period. So as you know, I mean, in the last 3 years, we have seen most amount of regulations coming in from SEBI, right, which tells us, okay, in terms of how do you distinguish, set certain boundaries over there. So that is definitely one change which is there. Earlier, it was more of an environment which was more of an interaction. It was a more fun, which was there.
How much of the SEBI rule is actually a very severe constraint?
So I would say that,
or unproductive, or actually meaningless. But
I don't think it is unproductive, but it puts certain kind of a discipline, right, in terms of what you're doing, which is good in a sense, right? What was there. So in the earlier days, it was a lot of informal discussions which we used to have, right? I mean, you could just walk on to someone, discuss about an idea, and it was more of an open environment. Over a period of time, okay, even we ourselves, okay, have put processes in place where we have formal meetings, okay, where we discuss about our company. There are certain times in a week, okay, where we meet.
You're talking about the compliances relating to information sharing, exchange of ideas.
Not really. This is, I think, as you evolve as a company, okay, you put in a lot of processes in place. Right?
Documenting your discussions?
Not documenting, also the meetings, right? Regular meetings. So you have proper meetings in place, right, on a regular basis. Okay. So like, for example, every fortnight, we have a meeting with the analyst team. We look at stock ideas which are there, recommendations with the fund managers, review our portfolios. We have a meeting now every month, okay, where we discuss the global macro. Because that's another. This we started some time back because, as we discussed,
these are your internal processes. These are not mandated by law.
These are not mandated by. So I think that what has changed is more process oriented, right? More formal, process oriented, and also to some extent, I would say that in terms of when you're looking at companies trying to do on the more ground research, I think evaluating management, right? Again, is an important part of our whole journey because we've seen that in the past, we would have erred on managements. I mean, sometimes we take management on face value, but I think over a period of time, we've seen that you need to have your own processes really, or forensic analysis to really see if there are any gray shades over there. And that's an area which we do a lot of work on currently.
So how much of it is now numbers and how much of it is gut?
So I think it's always a mix-up, right? Numbers and gut. I think as a fund manager,
more numbers, less gut.
So I would say
more gut, less numbers.
I think more of numbers now because now the information available. See, in the earlier days, it was more on gut, right? Because you meet a company, you take a big macro call on that. Obviously, numbers are there, but I think in the period of information, I think currently where we are, there's so much information which is there, and data is now available easily, and disclosure levels are much more for companies. So, and a lot of techniques have evolved, analytical tools have evolved, okay, which you can analyze and process data, numbers to make better decision making. So I think I would say clearly the amount of focus on numbers, okay, has increased over a period of time. And at times it's always the difference, okay, when it comes because information is available to everybody, right? It's the gut which helps you where you take a big call. And especially when you're betting on management, or taking those big calls where the numbers are not there. Sometimes it's not only about numbers, right? So then the gut. But I think it's more about numbers than what it used to be like, say, 10, 15 years back.
It's now fairly rooted in numbers.
Yes, okay. yes.
But gut matters, okay. This whole India story and this big tailwind, India tailwind, and we are quite looking forward to as multi-decade things, and Indian entrepreneurship and the global position right now, that actually creates a great opportunity. And the large and the mid and small cap universe is so large. We have such a shallow market, yet such a broad market. We have 3,000 companies which trade every day in our
Yes.
market, though you can't really buy them in huge volume. And you have always been a large cap fund manager, and it's been, the universe is narrow. Active funds are actually facing the heat of the passives, in the sense that given the cost, it's getting very hard for them to
Right.
beat it. So how do you, where does your heart lie?
So actually, while I've managed large cap funds, I mean, that's because the largest fund which is there, like the flagship fund. But I've always looked at all kind of companies,
Okay,
right?
the whole
so
universe.
initially, in the initial period, I mean, I used to manage 4 or 5 different styles which was there. But as you take higher positions, focused mainly on the large cap space. So my heart lies I mean, as a fund manager and as a stock picker, I get equally excited about a small cap company or mid cap company.
They're
And
more exciting
that's
anyway.
more exciting anyway, right? Where you can able to spot them early, right? Before the market recognizes that. So I would say, I mean, the passion is there to look at all kind of stocks. And I think over a period of time, you rightly said, in the large cap space, right, beating the benchmark has become a challenge. And it has a challenge, especially in the last 4 or 5 years, what we've seen that. And that's why I think you need to reorient yourself and try to, because earlier I remember when I used to manage the large cap fund, I mean, I could easily beat the benchmark by around 4 or 5 percentage points. I mean, that was kind of...
Just drop the duds and you're done.
Not drop it, I mean, if you're managing well, if you're in the top, right? If you're in the top, okay, top 10.
Why it was easy then?
I don't know. I think it was probably because now the
Because, there is
markets
no
are much more
large
mature.
caps, you don't have an element of discovery.
Right.
What more can you know about HDFC Bank?
Right.
What new thing can you know about Reliance Industries?
Right. I think what has happened is also a lot of passives have come in. Okay, to that extent, money chases some of the larger names,
The
right?
bigger ones.
Bigger funds or whatever. I think that could be the reason.
Auto allocation that is
and I
happening.
think the index itself was evolving, right? So when I'm talking about earlier, right? So even the large cap companies, they also were growing in that sense, right? So there were a lot of new companies which were coming in from mid cap into the large cap space. So I think that could be the reason.
Or avoiding the mortality in the large caps, like Arcom and Suzlon. If you avoid, you are done.
Probably. I mean, that could also be the
That could
reason.
also be the reason.
But I think over a period of one has realized that, I mean, you need to beat the benchmark by, you need not target, right, to beat the benchmark by around, say, 4 or 5 percentage point. Even if you beat by around a couple of percentage point, that's good enough.
It's good enough.
And accordingly, then you reorient yourself, right, in terms of what is the risk you take vis-a-vis the benchmark, and then manage that. Because the challenge comes in then when you take large bets outside the benchmark. And when the benchmark stocks do, like, for example, I remember in 2000, around 2018-19 period, right, 20 period, we saw Reliance really did very well, right, because of the whole transformation which they did, right?
After 7 years of slumber.
Right? And it was the largest benchmark stock. And if you're underweight that, because that was always a stock where you could take out, I mean, the reason for outperformance was some large benchmarks didn't do well. So that was a place where you could take out the weight and put into some other stock which you're doing exceedingly well, right? And that's how the outperformance came in. But that's not sustainable. So then it's important to really decide, okay, and that's where the underperformance started actually. If you look at the underperformance of the fund started mainly from 2019 onwards, for most of the funds in the category in that period. Also to this extent, the market rally in that period into the calendar year 18-19 was very narrow. Remember, there was only 5 stocks. 5 companies which, and the whole breadth of the market was down. The mid caps, small caps in 18 and 19 and 20 were down. So, I mean, how do you outperform the benchmark when you build a more diversified fund? So I think to that extent, I think now realizing that, right?
Being more diversified was proving to be risky.
Risky, right? Yeah. So then how much you diversify, right? How much you diversify in the benchmark. And that's where I think in the large cap, that's what we are doing now as a strategy. To beat the benchmark, and that's good enough, right? For investors, okay, to come back. And then in the mid and small cap, you can take a higher risk because there, the universe is very large, right? Mid cap, it's still limited now with the new SEBI regulation, but the small cap universe is very large. So if you look at it, the small cap funds, they beat the benchmark by good margins, right? Because in the small cap, the mortality rate is very high for the benchmark also, right? You have around 150
Yeah,
or
and I
250
think
stocks.
fund managers have proven
Right.
their
So
mettle.
it's more about bottom up. If you're able to eliminate some of the duds and have a process, I think you can do
You
that.
don't
So,
do a blunder, you are done. So
I think
you're a
India is
winner.
going to be a market, as you rightly said, the diversity is there. Right? It across, not only one of the most diversified market, I would say. And that's the beauty of India. A lot of other emerging markets are pretty concentrated. Like some of the markets are like China is more about financials, right? Some of the other emerging markets are more
so
of
are we,
commodities.
35% of our Sensex and Nifty is
35 is,
financial.
that is true for any market,
Is
right?
1/3.
Yeah. But see, financials, okay, are large, this thing, in any of the markets, right? But we've got the software industry, okay, which is there. We have the auto industry,
Consumer
okay, which is
business.
doing well. We have the consumer sector, which is doing well.
Telecom.
So, telecom. So, I think that's the thing. And then there are new companies which are coming up, right, in the mid cap and small cap space, new IPOs coming in. And the quality of companies coming to the market is also improving. Than
But
what
the
it used to be in the past.
reorganization of Reliance will actually create four or five more large caps,
Yeah. So I think so. It's the excitement is always there in the mid and small cap. Large cap is more about discipline, process oriented, right? Because there the weights in the benchmark are very large.
So this is the most important question I'm going to ask in my interaction with you, which is actually two questions together. How do you judge value in a business, and how difficult it is to find a value and quality together in the Indian context? In fact, value and quality together in the Indian context at reasonable price.
So that's been the biggest challenge. I mean, our philosophy, right, as a funders is GAR, growth at a reasonable price.
Okay.
And as you rightly said, we always want to buy good businesses with growth at a reasonable price. And that's where, classical sense, you will make big money over there. And in India market, because of too much money chasing, and there are a few companies which were that, they're always expensive. So value again is a very, very term. Okay, how you define value, right? People define value as where price to book value, right, is low.
The classical
way of definition of value. I would look at value as what you're doing in the market is trying to find stocks, okay, where the price is below its intrinsic value, which is there.
Okay.
And intrinsic value is basically trying to project, okay, what the company's value, future stream of cash flow is. So the idea for value for me is to really try to see company in the potential what it is, right, in terms of future earnings, the future growth, right, to discount that and see, and whether the current market price, okay, is giving us reasonable upside in that. And it could be not necessarily a low PE stock or low price to book value stock or reasonable. It can be an even expensive company, but you're able to see the value, the growth opportunity which the company could have over a longer term period. And if you discount that and factor that, it could still be value. So I think GARP in its traditional sense, okay, where it says that you need to buy a stock, right, which is the P multiple probably is near its PEG ratio. That's no longer holds true in the context. So you have to also understand the longer narrative and story behind the company, right? What is there? And that's been again a learning which we have institutionalized. What is the story behind the company? Because that tells the big picture of the company. And then that you factor in terms of your future flow or future earnings, okay, what potentially the company could do.
But give me an old example of, where there was, you found the business high quality.
Sure.
It turned out to be reasonably priced.
Right.
And it turned out to be a reasonably fast growing company.
Yeah.
And it turned out to be a good opportunity for you. And you don't find any such situation now.
Sure. So I think one is growth. Where do you get growth, right? When there's a big opportunity size. The target market is huge and the company is still small, right? That means the runway of growth is very large. Right? You identify that company. So I'll give an example, right? A stock which we have in our portfolio, Titan, for example, right? I remember Titan around 7-8 years back, okay, when we bought. I mean, we all know about Titan, the jewelry story, okay, which played out. And I mean, they were growing at a reasonable pace, but still, if you look at Titan, was still around, say, 3% of the organized jewelry market. And looking at the strong brand, say, in terms of quality coming from the Titan house, I think that was never an issue. Good cash flows. Okay.
You're talking of quality of the product or quality of corporate governance?
I'm talking about both. It's very important. It's quality about the cash
management.
flows.
Okay.
One is the quality of the business itself, right? Which is measured by the quality of cash flows, what you have, right? free cash flows, and the return on capital. So that's fundamentally a good business. And then it's the quality of management, right? Because that is also equally important, because a good management, okay, will ensure that even if the company goes through a cycle, right, they will reinvent themselves, right?
Navigate
and do that,
itself.
navigate themselves. So again, Titan at
It
that
became a jewelry company from a watch company. So
that was the one transition which was there, right? And then at that point in time, when I remember when you bought Titan, right, the valuations, okay, it was at around say 30p multiple, which is still high. It's not like it was like 15p multiple, but the kind of growth runway, okay, which we could see over there, around kind of 15-20% growth, can grow for the next 15-20 years, right? 20 years, because from 3% organized, right, even if you go to up to 8%, and the market itself is growing, that gives you a good runway of growth. And so that was a classic case. Unit was slightly expensive, okay, not what it is today. Now the stock is around 55 multiple or something, right? In that sense, so now clearly it's no longer. I mean, one can debate about it. Yeah, it's not as attractive. What, and when you get that combination of some reasonable valuation and runway of growth, then I think you have a winner at hand, because not only earnings are compounding also, but there's a chance of PE re-rating to also happen.
How do you actually, so at its current valuation, what is the story left for Titan? How do you deal with it? You spotted a great company, it did well, and now it is too expensive.
Sure. No, I think still, I mean, for Titan, like company, the runway of growth is still very large, right? Because still there's a large opportunity which is there.
It is still a scalable business.
So, but the valuations are not in your favor. So it's fairly priced. You might not make the kind of returns which we did in the last, say, 5-6 years. So in that scenario, I think in the portfolio, when you're managing a portfolio, right? I'm coming from a portfolio perspective. You own that stock, continue to own it only to the extent you're comfortable owning the stock, even if it doesn't perform for the next 1 year.
Okay.
Right? Okay. So, but you want to have, because it'll catch up over a period of time.
And it's not a big drag on your performance.
It's not a big drag. And there are opportunities in the market. See, what happens is the market always gives you opportunities, right? Whenever there is some amount, there could be a quarter, because market is sometimes too focused on short-term numbers, right? There could be a quarter where the company will not do well, or probably gold prices, okay, will go up,
unfavorable,
right? Unfavorable, and market could react, and that's the time you get opportunity really
there
to
was
add to
something
that.
that happened about the regulations about gold financing scheme that they were having,
right?
That was being talked about or implemented, and it actually
So a lot of these things, news. I mean, the journey for a company is never linear, right? The earnings, right? There are a lot of these events which happen, and that gives you opportunity really to add on to a position, okay? Because when you find the risk reward is slightly better, so I think that's how we really manage. Because in the past, right, some of the companies, okay, we probably sold them because of purely on valuation basis, right? And then once you do that, it's very difficult to buy again into the stock, because the mindset, right, in terms of valuations, especially for good quality companies, I think it's very difficult to again re-enter.
Now, another important question. Given your 30 years of all the hits, misses, and watching evolution, how do you define great business? We understand that the academic definition, a business which is growing, a business which has good quality earnings, return on equity, return on capital employed, and managed by a good set of people. But what is your definition from a portfolio point of view? Something to be added. What is a great business?
I would say that earlier, right, and how it has changed a bit, right? It was more towards the profitability, okay, the return ratios of the company, okay, which was important, okay, to look at it as when you say a good quality business.
You will not settle for anything less.
Yeah, so that was one of the that was one of the important, the free cash flows, which are very important factors, right? Which are very important when you're looking at a company, which are non-negotiable. But I think increasingly, I think what I realized, and again, it comes from experience. I think the people who are driving that business, right, the management, one is the professional management, and then there's the promoter. I think who are the people driving that business? Okay, that if those people are capable and good, and the managements, the promoters have the vision, I think those are great businesses, right? Okay. Because those are very difficult to quantify and measure that. Because I've seen many companies, right, where the businesses have been pretty ordinary, or circumstances have been difficult, but because of good management, right? And
give me an example.
Classic example I'll give you, right? Again, a stock which we invested a long time back. You know about Bajaj Finance, right?
Yeah.
So financial services company, again, they went through a big phase. I mean, never been really successful in the 2005 period, and after the crisis which happened, right? They had severe losses on their retail and on the personal finance book, right?
On the lending.
And they were essentially doing lending to the captivity for their for the parent Bajaj two-wheelers, and this company again,
Which was
went
Bajaj
through
Auto Finance Limited.
mainly that, and they were doing some personal, and they had a very bad experience in their lending and went through a very bad phase. And then when we met the company, okay, say in 2011 or so. So we found the new management, okay, had taken over, and this is the company they were trying to again transform this company, and that's the first company which struck us that they were looking at lending business in a different way, right? How to look at data, and that's in very early days. How to use technology in terms of evaluating risk and then deciding whom to lend to, right? And that was the first company which I
By
saw.
that time, CIBIL has come into play.
CIBIL had not really come into
Okay,
play, right?
still
But they were devising their own methods of getting data, analyzing data, and then using that as a metric. Earlier, lending was just based on some kind of you look at some
compliance
numbers,
mechanism.
numbers, or some kind of cash flows, or you lend only to a certain people, okay, who had some salary income, but you wanted to grow beyond that, and that's what I think was a big change, right? And we know, right, what has happened in Bajaj Finance since then. I mean, that company has evolved over a period of time, and is a pioneer, right, in terms of the
Being able to catch a borrower at the point where he may not be even
I mean,
thinking
the
that
kind
he's a
of
borrower.
because of technology, not only you're able to manage your and improve underwriting skills, but also experience with the customer, right? Because finally, it's also the experience with the customer, how quickly you're able to turn around. I mean, who could give a loan, okay, in a matter of few minutes, instant gratification? That's what they did, right? So you got into the store, okay, they know everything about the customer, right? Because they have all that data at the back end, okay, they have already decided, okay, once you've given your details, they already pre-approved the loan, right, based on your data analytics what they have done, and immediately they can approve it. And so that kind of gratification, okay, when you do, which is the first thing, right?
And reducing the delinquency risk to virtually nothing.
I mean, delinquencies will be there, but you're trying to manage that. And that's when you want to build scalability, right? Because you want to also buy a business, okay, and which can be scalable. I mean, there's no point buying a business which is good, but it can't be scaled. There are many good companies I've seen, good cash flows, good profitability, but no scalability. Classic example is Castrol, MNC company, right? Very
Which
strong.
your father had.
And that period, it was a fantastic period. But what you've seen is in the lubricant business, there's no volume growth, right? Because the quality of lubricants is increasing. You don't require that much, right?
Okay.
So there's no growth, but that stock has not done. I mean, that was a different era. So
Or was it also servo?
not really.
Not
it's
really.
not the industry itself, the category
Have not
itself.
expanded, okay.
The volume growth is almost zero, right? So you
And
also,
then it can get really zero if electrics actually take over.
that could also be the reason, right? Why the multiples. So I think what I'm trying to drive a point is that the betting on the right management, right? I think the leadership change which happened, right, in Bajaj Finance made all the difference over there, right? And so that's
And they were actually learning on the go with all the
I think-
mistakes.
and you don't assess a management immediately the first time you met him, right? You meet the company at various intervals, right? Your interaction, the engagement with the company really tells you how the company is thinking, how they are implementing, how they are making changes to their strategy, how they are improving incrementally, and the passion also, which, okay, I mean, it has to be a mission. I mean, great companies are when the promoters or they have the passion in that. That's where you excel. So I think that's very important, okay, another factor, okay, when you talk about great businesses. I think understanding about the management, the leadership, it could also come from the promoters. I mean, the classic case, okay, could be, say, a visionary management, which is able to transform the company, right, which you can't think about it, right? And that's a different kind of thing. Like, for example, a company like Tube Investments,
Okay.
right, which is there.
Tell me your key learnings from some of the stories which did not play out, Future Retail, Z, this, that, Has it translated into some kind of rules being formulated at your place that what you will not fall for again?
Yes, that's a very good question, because I think there are a lot of companies, okay, whom you thought, okay, they can be big or can be big winners. It hasn't materialized or didn't play out. And there are various reasons for that. And I think all those learnings crystallize in terms of putting some discipline in what you won't want to buy. See, in the marketplace, okay, there are many companies which you can make money, right? But avoiding mistakes, right, is also very important. And if you have certain principles in terms of what you want not to buy, I think then you are avoiding because,
negative list.
because see, at the end of it, what do you want? If it's a personal portfolio, you want say around whatever 10, 15 stocks. If you are managing a portfolio, you want around 50, 60 stocks in your portfolio, which can give returns. So I think clearly, learning from some of the mistakes like in investing into companies, I think clearly there are certain rules in terms of what you don't want to buy, right? So a couple of those could be like companies, right? We've seen many companies show very good growth, right? And you know, I like companies, right, which are growing because that's where
That is where the
earnings are
magic is
growing.
here.
Yeah, magic is there, and you'll see that. But if the cash flows are not, if companies are generating cash flows, right? It could be operating cash flows, I would say. Free cash flows might still not be there because you're investing for growth. I think then one needs to be careful because that's a classic problem, okay, where the numbers could be inflated, right?
You can just make it up.
You can make it up, or probably it's been badly managed, right? At the end of it, if you're not generating cash flows. So I think if we see a company which is, I mean, it can happen for a few years, right? Because you're going through a cycle. But if you consistently for a long period of time, company, they're not generating cash flow, that's clearly a red signal, right? Clearly, we would want to stay away from those names, even if the profitability over the numbers growth could be very good. Second is in terms of, as I said, on the promoters, right? Promoters trying to misallocate because a good company we can see can go to the dogs, right? A good business because the underlying business
make
will
money
be good.
and the money can evaporate,
and the
yeah.
money can go away into some other unrelated businesses, which can pull down the whole
It
the
may not
company
be as productive.
as this thing. So I think wherever when we see misallocation getting done, I think, of the cash flows rather than returning to shareholders, I think clearly those are the companies you want to avoid. And then also a lot of Indian promoters, if you see, they have a lot of other businesses, right? So there's always inter-party or inter-group money transfer which happens, right?
Yeah.
So related party transactions, okay, where they are there, I think one needs to be very, very careful because invariably what happens is that when one company in the group goes through a kind of a problem,
Bad patch,
okay,
and
it can probably could
can
be a
suck
conduit
all the
suck all
resources.
these things, right? So I think and also companies where promoters are levered, right? In context we see many times companies promoters pledge their shares, right? And that can have a cascading impact, especially when there are market downturns and the pledges can lead to, we've seen promoters getting wiped out virtually, right? Good businesses, promoters, they pledge their shares and in a market downturn,
and now they have been thrown out of the company.
So I think these are some of the rules, which
And this is something which has become very mainstream now, a thought which comes because earlier promoters were not, promoters used to die with the company.
Right.
And the company used to survive forever.
Right.
No longer.
Right. So now the good thing, at least there's a change of hand ownership and the company can revive it, the new set of promoters, and you've seen that. I think that's what the regulations, what has played, where good business, there is a chance, for some new promoters to come in and revive that business.
Unlocking the resources.
But in the interim, I mean, the shareholders go through a big pain.
Your fund struggled for a while and now they are, showing symptoms of a revival. Now they're making a comeback. Some of them have made a very impressive comeback. What went wrong and how painful was it?
So I think in the journey, I think what we've seen that there are certain things which happen. Cyclicality is there everywhere, in businesses also and in fund management also, right? You have a stretch of period, which is a very good period. So we had a wonderful period for our fund house from 2013-14 till 2018, where a lot of funds did well, our AUM grew, our market share grew. And there was a patch, when some of the funds went through, across again, probably it was a phase in the market where our style was not, probably, as I said, our style was
out of favor.
Yeah, our style was growth at a reasonable price. And we had a period from 2019, 18, 19, 20, where it was growth at any price. Like we talked about some of these high growth stocks. They become very expensive and then we couldn't buy them, right?
It's not, with a very interesting angle, acronym that came about, which is BARP stocks, buy at any price.
Buy at any price, right? And the markets were probably, that was a phase in the market, right? And we missed out on some of those opportunities. Also, that was a period when the market rally was narrow, which we talked about it. And normally we had a more diversified funds, right? And that's what I think our philosophy was, rather than having concentration, except for a couple of funds, right? Where and that also was a problem later on. I'll come to that, right? And so that also hurt us to some extent. And I think over a period of time, okay, we realized, right, in that period, that what is it, okay, what didn't work for us, and we started introspecting, because when you have a period of underperformance, right, you start to look into it. And also we were probably missed out on some of these mid cap and small cap. We were not as strong as one would have been, because subsequently we saw, right, after the COVID, right, there was a big rally in mid and small cap space. So I think that was a period, okay, where we had some underperformance.
What has led to this turnaround? What has caused this turnaround? You're just beginning to improve on the numbers, stacking up numbers. So what has happened? What you did?
Yeah, so I think in the period, again, as I said earlier, there are different phases which we have gone through. Okay, so whenever there has been a period of underperformance, it's a time to introspect and reflect, and take certain decisions, whether you want to make certain changes or improve your processes, systems. So in the last 2 years, there are a couple of areas which we have worked on. One is on people, processes, and risk management and monitoring. So on people, we have strengthened the team, right? What we saw was we had a very good analyst team, senior analyst team, and they were also now started managing funds. So we've given them additional responsibility, which is good. But at the same time, we needed to also, the market, if you look at in the last 3-4 years, the number of companies has increased, a lot of new companies which have come in. And we needed to give them support. So we hired a lot of junior analysts who will support the senior analyst, because we don't want the senior analyst core competency in that particular domain knowledge to go away, even while they are managing funds. So we hired some junior analysts to support that. That gave us a good coverage on the companies, because we found out that it was very important, the analyst bandwidth to look at a company, okay, because is only around 30-40 stocks. Beyond a point, it becomes difficult. And the investment universe, which used to be around 350 odd stocks, had gone up to around 450 to 500 stocks. So clearly, to do justice,
It is beyond.
Okay, we needed to really get and more on the ground. And I think in the market, we realized that it is also more, now information is available everywhere. You need to also do all the more ground research, right? You have to be slightly ahead. You need to not only look at the numbers, you also need to look at what's happening on the ground, what the distributors are saying about the company, right? What the customers are seeing. And that's where I think our focus has been to do more on ground research, and that's why we increase our analyst strength.
How difficult is anchoring these set of people? Because the nature of this job actually changes completely. If somebody has to go and validate the operations or the flow, or the conduct of a business or customer's experience of a business.
Yeah. So I think the good thing is that while we do it, I think there are a lot of agencies, right, in the marketplace, okay, who do that.
Okay.
Right. Idea is to really
you seek your help.
Yeah. You tap into those and then try to get that information. So yeah, and in some cases, okay, you would want to do it because it's not always possible to do it physically. That was one area. Even in the fund management side also, we strengthened our fund management team. Okay, they had certain people, fund managers exited. And especially on the mid and small cap side is an area which we thought we were not as great. Because if you see our large cap, flexi cap funds have done well. Mid and small cap hasn't done. So that's an area we really wanted to really improve upon. So we got our head of PMS, okay, Vishal Gajwani, to come in and look at our small cap fund.
Okay.
Also, we had a specialist small cap analyst, because a lot of our analysts were there. They are focused mainly onto the larger names or mid cap companies.
Sectors or...
Yeah, sectors. And we needed somebody who could look at companies across these sectors, right? And look at new ideas. So we had a small cap
characters
analyst.
of the business.
Yes. So we had a small who look at only companies, say under 15,000 crores market cap. And that has helped us to really get new ideas, right, into the companies. And that has also seen a good turnaround in a small cap fund. And so that's on the people side what we have done. Strengthen the team, okay, added more resources. Now we got a good blend of very young people,
youngsters,
a good level of middle level people, and senior fund managers.
And small cap guys.
And the small cap guys. So I think that gives a good blend, because...
That also gives me a sense that, you are actually very upbeat on the small cap thing carrying on. Or there will be...
Yeah, I think we are. There's been a lot of talk about small cap, okay, while there has been some exuberance in the in the near term. But we think if the Indian economy does well, right, and we are bullish on that, right, there are a lot of opportunity for mid and small cap companies to do well over a
which
long
will
period.
Sustain itself.
Yes.
Okay.
So that's on the people side. On the process front, also a couple of things which we realized was that while we had a lot of good ideas, we identified a lot of good, but we never had large ownership in those stocks. We were very well distributed across our funds. So we said, okay, fine, why don't we really focus on a few large, high conviction idea of an analyst and try to have a larger ownership? Because out of a universe of around
spread across funds.
Yeah, across funds. So now we have from the analyst high conviction ideas. Okay, we have a model portfolio for a large cap, mid cap, and small cap, and each analyst will have around 8 to 10 stocks. Okay, in their sector, which are their top high conviction ideas, and the idea is to build larger ownership in those stocks, right? So the top whatever 120, 30 stocks is where we build larger ownership, because these are companies which are well tracked. We are on top of it. High conviction idea for analysts.
So narrowing your circle of competencies.
Try to do that, right? Okay, that's somewhere I think which I think will help us. And also we've got sometimes you miss out a company, okay, when you're looking at purely from a 1 year perspective. So we also have a 3-year ideas coming in from analysts, which gives you to look at company beyond for a longer term, because you want certain companies in your portfolio, okay, which will be long term, and they might not be cheap as we talked about it, but you have to have a long term perspective over there. So that's something which on the
process bit.
And again on the stock selection, when we talked about it earlier, it's also about trying to build a narrative of the company. So we're not just looking at numbers, right? The P multiple or the cash flows, but what is the story behind that company? Trying to understand
how true it can be.
Yeah, so we have, because as I said, it's not only about numbers or valuation, it's also about the story behind the company also, which is very important to decide on how to value that company. We talked about expensive, right? So we have built these 8 narratives. Like, for example, a company could fall in the bucket of established compounder, right? Or visionary management, which we talked about that. So those companies will not be cheap because their earnings are compounding steadily, right? So you need to give a premium to that. It could be, other narrative could be a small size and big opportunity, which we talked about, very high growth companies. So those companies you have to look at in a different way, because we talked about Titan, right, earlier.
Yeah.
So long runway of growth.
Titan, Asian Paints,
which are there, the D-marts of the world, right?
Yeah.
Where you have to look at it a bit differently, right? Because you have to have a premium for that. Then the other narrative could be turnaround companies, right? Where the companies are turning around, right? So from the earlier businesses, so there could be a turnaround because the company has chosen, okay, to enter into a new line of business. So that the past earnings won't really matter over there. Then there are cyclical companies you look at differently, mildly cyclical companies which are there. Then there are disruptors which are there, which is the new age companies, right? These are companies totally disrupting the business. So there you can't, there are no numbers to value, right? Numbers which are there, because they are investing, and if they do that, there's a large opportunity for them to really capture that. So a lot of new age companies which are there, whether it is Zomatos of the world, so those companies have to look at a bit differently. So you have built these 8 narratives now, which helps us to really appreciate in terms of how do we look at a company and not just beyond the numbers. So that's another change, okay, in the process front which we have done. And also we now have, especially for some of the niche sectors or emerging sectors, if you're able to capture them early, then you can make a big difference.
Give me an example of a niche sector ahead of curve.
Like for example, in some time back, it was specialty chemicals around 3-4 years back, right? Which came in and we saw that, right?
Which is now
big,
roaring for now.
And to some of these niche sectors which are there, you might not have that competency because our analysts are focusing on some of these normal traditional sectors, right? They are small sectors. Like for example, recently what we have seen happening in the defense sector or in the electronic manufacturing space. So we are now inviting, as a part of our process, we have a knowledge series where we invite industry experts and consultants to give us insight into the sectors, because you'll not get much knowledge of that, right?
You won't have it.
You won't have that. Like we had, so we have these series where we invite consultants and give the good insight in the sectors at the early stage. Currently, what's happening in the new energy space, right? In the electric vehicle space or energy transition, the green energy, I think these could be the emerging sectors. And if you're able to identify this early, even if you don't have a large allocation in your portfolio, they can be multi-baggers. So that is something which
special situations can emerge out of it.
Could emerge. So that's what we are doing. And then finally, I would say it's on the risk management and monitoring, because I think in the past, our experience has been that when do you intervene? Some of our funds underperformed, right, for a long period of time. So when do you intervene and start taking corrective actions? Because so that's, I think, the monitoring mechanism.
So when a story doesn't work out, is there any upper time limit in your mind?
Yeah.
3 year and you'll give up?
So one is at the stock level, right? So most importantly, what happens is that as fund managers, sometimes we have a lot of biases within us, right? A lot of stocks we know, but we get emotionally attached to it. It happens,
Yeah.
right? And you don't want to sell the stock.
Because you bought it in the first place, it is among the top holding.
So you
build
continue
the case around
to hold on the stock, and we've seen the fund managers in our funds also continue to hold on the stock even if they are underperforming. And that's the time I think where you need to put certain interventions in place. So we have defined certain thresholds internally. If a stock underperforms beyond a particular period,
And this is a normal course. Most fund managers are very averse to admitting to their mistake.
yeah, it's very
It's a very
difficult
natural
really. I would say.
psychology.
So we put a process in place that if it underperforms beyond a particular threshold for a certain period of time, okay, there's an intervention
Period
which
of
is there, period of time, where clearly the fund manager and the analyst sit together. We take the view of the fund manager and of the analyst, record that, and we show the mirror, right? And there's an accountability which is there, right?
Okay.
The fund manager can continue to still hold on, but he's now accountable, right? And there's a justification, okay, which he needs to do for that stock. And when you show a mirror to a person every time, okay, he will automatically
For the outlying underperformance.
underperformance, and you can take the corrective action over there. So that's one part of the process. Even at the fund level, at the portfolio level itself, if the fund underperformance vis-a-vis the benchmark beyond a particular threshold, okay, there is an intervention which is there where you sit with the fund manager, you analyze. Basically, it's more about having a discussion. You analyze where the underperformance is coming in from, and having an action plan really to get the performance back. So put in a tracking mechanism. It's more about putting checks and balances, providing support.
Putting a flag that, get alerted about it.
Yes. And we also we are developing
Is it primarily in terms of an intervention that you have to do it? It triggers an action, or it is basically making him conscious of the seriousness of the magnitude?
It's basically showing a mirror to a person, right? And trying to really work, okay, because normally the fund managers, okay, will independently give them the freedom to do, but whenever it is required, okay, you get the support of the whole team really to rally behind that. And we are also creating a kind of a scorecard, okay, at a stock level to identify the risk associated with the stock, right? So that will tell us in terms of what should be our ownership. And the risk could come in either from, we talked about management quality. So a management quality scorecard which we have built, it can come in from volatility of their stock, right? Or liquidity. And there are three factors, okay, which can determine the riskiness of a stock. So what is the ownership we need to have of that stock at a fund house level?
Okay.
Because many times what happens is that in the past we have done that, right? Where your ownership in a stock, okay, goes up, and whenever the risk manifests, okay, very difficult to exit that stock.
You can't do anything.
Right? So we are identifying those risk thresholds, okay, at the stock level, and also at a portfolio level, okay, how much we can have. So these are some of the measures, okay, which will ensure in future, okay, whenever, even if we have a period, okay, we should be able to manage that.
Oh, you said all these things about, how you will actually not let bad things happen or control the risk and all that. What is the incentive system for the guy who succeeds? Somebody does all this. How that is getting aligned? Have you done something about the compensation?
So
aligning it with performance in a more objective manner?
Right. So I think for the fund managers, okay, this is pretty much simple, right? In terms of...
No, I don't know that it is that simple. Tell me how simple it is.
No, so see, I mean...
How it works.
I mean, value research, for example, right? You have all quartile analysis which is there, right? For each of the fund, right? So we have our own benchmarks, right? So the fund performance measurement is very, very objective. And you can link your reward.
That is a numerical exercise.
Yeah, numerical exercise where you can link the reward to the fund manager, right? If he's in aspiration. See, our aspiration is that we need to have, say, 75% of our funds in quartile 1 and quartile 2.
Okay.
Right? And at least say around 1/3 of the funds in quartile 1. If you do that, I think we have done well. And that's the baseline, okay, for the fund manager. And aspirationally, you want to be in quartile 1. So our compensation is linked to the relative performance.
Relative performance.
And also we are now looking at benchmark or performance. Okay, that's
but 1 year, 3 year, because sometimes you can have a cyclicality and which will it can go blockbuster in third year.
Right.
And for first 2 year, he actually is being slapped every day.
Right.
You're giving him a flag, showing him a mirror, ki tera kaam nahi kar raha, and then third year it actually goes ballistic.
Yeah. So I think we have moved now towards going from 1 year to a 3 year period, I think.
Okay.
Because 1 year and 3, because I think it's important for fund manager, because things can't work out because the market conditions. We want fund managers to show conviction on the table and not just governed by the short-term movement, right? So a 3-year is also a part. I mean, it's a 3-year and 1 year is a composite kind of weightage, okay, which we give when we evaluate fund performance. But for analysts, I think it's how much alpha they're generating, right? So the model portfolio is what we have, right? Is a good measure of generating the alpha, and then accordingly rewarding the analyst in terms of what alpha contribution, okay, what they're doing. So that structures alpha earns them this thing, and that's where I think we need to get skewed a bit in terms of rewarding the analysts, okay, which are generating good alpha, and then that's where we are working towards that.
Markets are now at a very handsome level of 20,000. Of course, it's a nice big round number, but where do you find opportunity now?
So I think you're right. I think the market is there, but if you look at the large caps, really, right? If you look at the Nifty, it's not as expensive, okay, as it's made out to be. Market is a new high, but if you look at back, okay, when the market created a new high, which was in 2001 October, right? Yeah, which is there. Since then, the earnings have grown by around 27% or so. So the market large cap is slightly above the long-term average. If you look at, and
in the vicinity of
the vicinity of it. It's not cheap. It's not cheap. There's a lot of euphoria, some euphoria in the mid cap and small cap space. Within that also, if you look at the banking sector, for example, right? A lot of the large banks, okay, are somewhere near the long-term average in terms of the price to book. So I would say that the market is not cheap. Okay, it's pockets of the market, like few sectors, like for example, capital goods or infra. We've seen a big rally over there. But otherwise, I think the market is fairly priced, right? Priced, so I think here you are now buying really future growth. So you have to look at companies and sectors, okay, where the growth visibility is good, because
and you should be right.
Yeah, you should be right, because you might not get a re-rating in multiples, but if you are call on growth, so which are the sectors, okay, which you think
which will keep growing,
which will do well. And the good thing is that for the first time actually I'm seeing, right, in the market, there are multiple sectors which are doing well. Okay. It's not like a few sectors which are doing well, and that gives a lot of confidence, right, that the markets, okay, or the economy will sustain. If you look at pre-COVID and now, okay, there are many sectors which are doing well. Like for example, the real estate sector, right, which was in a very bad phase, right, from 2013.
RERA and all the scandals.
So that's now coming back. Okay, we have seen a very healthy demand and a much more sustainable, genuine demand which is happening. The capital goods sector or the investment cycle is now picking up.
Been revived
after a long period. After 2013, we have seen capex investment to GDP has been going down. That's coming back. So that's again manufacturing sector again is coming back. So a lot of the sectors are now doing well. Even auto sector for that matter, right? Pre-COVID, if you look at auto sector was going through a downturn, and that's now reviving. So I think given that, I would say that the market itself, first is the call of the market
opportunity itself, of a different kind that you have
different
to look
kind. I think for the first time, I think the visibility, just like we talk about a company where the long-term visibility of growth is high, and that's what we are seeing for Indian economy. I think after a long time, after the reforms what we have done in the last 7, 8 years, I think now is the time to reap the benefits of that. And I think for India, the runway of growth is going to be fairly long. And once you see that, right, then the market, even at these levels, for a long-term investors, there is reasonable returns to be made.
Could be attractive.
I mean, you might not make extraordinary returns in the market, but I think reasonable returns for the risk, what you take in equities, the risk adjusted, I think the markets can still give good returns. And I think at this point in time, the large caps, I would say, relatively look good, but
they look like better value today. Okay.
Relatively better value, but I would say even for mid and small caps, right? While there are a lot of exuberance which has been there, you might see a correction, but I think if the Indian economy does well, right? When the earnings, because a lot of mid cap and small cap companies are more domestic focused, right? So you will see the growth probably trajectory for them to be good over there. And there are always bottom up ideas, okay, which are there.
They'll be able to justify their valuation.
Not all companies. So you have to be very, very stock specific. Like, I mean, this is a market, okay, which will be more stocks specific, and you have to be really careful because the liquidity driven rally, what we have seen, right? A lot of retail money has come in. I think you have to really separate out, right? The companies from the fundamentals.
You mean one should be apprehensive?
They should be cautious.
that money going out or stopped coming any further?
In the market.
Yeah, are you referring to the retail money coming into the market as a red flag?
So
And is it going to be? Are you referring to the? Is your fear is that the money will go out or the money will stop coming further, because it has been SIP money?
No, so I'm not worried about what's coming into the mutual fund. I'm saying about pure direct money.
Okay,
right?
direct
So there are a
money.
lot of platforms. Actually, after COVID, what we've seen is that a lot of young investors have come to the market, right? There's so many accounts which have been opened. And these are young people who haven't seen the market, right? They haven't seen the ups and downs in the market. They
Investing
have seen
stock
this,
has been
right?
democratized further, yeah.
So I think I'm worried about
Them
those
pulling out.
investors, who are, and they are really going by returns. They are not really driven by the fundamental, right? And that's where I think in some of the pockets, there is a need for it. But otherwise, I would say for a long-term investor, like continuing with the SIP at these levels, even a small cap and a mid cap, I think one should continue. Definitely, one should do that.
Not much. So I have asked a lot of questions. Now I want to ask just one question. When you're not managing money, what else do you do?
So when I'm not managing money, I think the best time is, you get limited time, right? Time to spend time with your family, right? So I've got 2 daughters, right? Try to spend as much time with them, right? And see, we are in such a business, right, where even if you go
They're
back,
still
right,
able to spend time with you, because growing up, daughters, they don't really they stop spending time with you.
Yeah, so that's true, right?
Yeah.
So, but how much ever time you can to spend, I think that's the time you should
derive
because,
out of it.
Because in our world, right, we don't stop thinking, right? Even if you are out of office, right, markets and everything is always going up in your mind, right? So I think family, going out, I think that's the time to really unwind, reading books.
Okay.
Yeah.
So books, spending time with daughters, and that's it.
I would love to travel actually, because that's something which is there. I think try to explore new places. Hopefully down the line, when you get more time, I think
Are you
one
going
could
to
do
be
that.
left hands-on now?
Yeah, so I think as over a period of
Will you
time.
be directly responsible for managing funds?
So I think so now what we have. Again, this is a recent development. So we have got a new head of equity, Harish Krishnan, who has joined us. Again with a good background, and again very good process-oriented person. And he will be able to again build the team and take it to the next level. So
And you will be
going
mentoring
forward,
them, and you will be keeping an oversight.
I'll continue to manage one of the large funds, which is there, because that has been like Frontline Equity Fund has been kind of in my bloodline for the last 18 years.
Like your baby.
To do that.
So,
So continue to do that, but I think providing guidance to the team and then really mentoring and seeing that
And
we
refine the
take-
processes
refine
and
the
keep an
processes
oversight.
and into the next level. So I think that's how I would look at it. But given an option, I think sometime, I would also again like to do more, give back to the society, because I think what the market has given to me, I think giving it back in various ways, right? It could be philanthropy. It could be also trying to really give knowledge, to young investors, right? Going and probably teaching students, right, in terms of the whole experience, what you have in your journey, trying to impart that. And that's something which I would like to do, down the line.
It was a great pleasure talking to you at length about things without the pace of the market.
Yeah.
So thank you very much for your time and insightful experiences being shared with our viewers. Thank you.
Great. Pleasure interacting as usual.
Thank you.